The European Central Bank raised interest rates on June 11 for the first time since 2023, reversing a two-year campaign of cuts designed to pull Europe out of stagnation. The trigger wasn't runaway spending or a booming economy. It was a war in the Middle East that closed the Strait of Hormuz and sent oil past $100 a barrel. Inflation hit 3.2% in May, driven almost entirely by energy costs Europe can't control. The ECB's Governing Council concluded that letting prices spiral was riskier than choking off growth, so they lifted the deposit rate by a quarter point to 2.25%. Christine Lagarde called the decision robust across three scenarios, all of them bad. 110,000 Irish households with tracker mortgages will see bills jump immediately. Another rate hike is already being discussed for July. The irony is sharp. The institution that spent 2 years lowering rates to revive the Eurozone economy is now raising them to fight an inflation shock it didn't cause and can't stop. The World Bank is calling this the largest oil supply disruption in history. The ECB is treating the symptom while the disease, a closed shipping lane 8,000 kilometers away, decides how long Europe's recovery lasts. Shipping industry associations in the Philippines are advocating for an open pilotage policy to introduce competition across all ports in the country. The reform aims to break what critics describe as monopolistic practices that inflate costs. If implemented, the policy could lower freight expenses, benefiting consumers and businesses reliant on inter-island shipping. Lower shipping costs would reduce prices for goods transported across the archipelago, a critical factor in a nation of over 7,000 islands. The push reflects growing pressure to dismantle entrenched industry structures that limit competition and harm the public interest.